Welcome to Griffonomics. So, what if I told you the absolute best thing that ever happened to a $200 million biopharma company was, well, utterly failing their most important, massive phase 3 clinical trial?
I mean, it sounds completely counterintuitive, right?
Right, because, usually when we talk about biopharma on this deep dive, there is a very familiar, almost exhausting narrative. You have these companies burning through hundreds of millions of dollars, running these massive clinical trials, and basically operating on a prayer.
Yeah, hoping that one day they'll appease the FDA and hit the jackpot with a blockbuster drug. It's a relentless cash incinerator model.
Exactly. It just burns cash.
And that model is entirely predicated on hope. Investors are essentially buying, lottery tickets disguised as equity, and they just wait a decade for binary trial results while their investment gets diluted over and over again to fund the research.
But today, we are doing a highly granular, investigative deep dive into a company that entirely flipped that script.
Yeah.
We're looking at Kamada Ltd, ticker symbol KMDA.
A very interesting pivot.
Oh, absolutely. The mission for today's deep dive is to explore how this company executed what you could call a textbook margin inflection. They pivoted away from being an R&D-heavy biotech chasing pipeline dreams and transformed into a highly profitable, cash-generative commercial platform.
Which is incredibly rare.
It really is. So for you listening, whether you are analyzing corporate turnarounds, looking at capital allocation, or just trying to understand how a company builds an unassailable economic moat in a volatile sector, this is a masterclass. Okay, let's unpack this. When I first looked at this company's recent filings, I expected a standard cash-burning biotech. But they just posted massive operating cash flow.
Yeah, they really did.
Give us the 30,000-foot view of how they flipped the switch so fast.
Well, the foundational shift is that Kamada aggressively transitioned from speculation to commercial execution. I mean, their latest annual report details a company that just finished 2025 with record revenues of $180.5 million.
Yeah, 180 million.
Yeah, which is up 12% year over year, but top-line growth is only half the story here. Their net income jumped 40%, and they generated over $25 million in pure operating cash flow.
That is just wild for a biotech company.
It really is. They ended the year sitting on a cash fortress of $75.5 million with negative net debt, and they achieved this by leaning heavily into their proprietary specialty plasma therapies, fortifying a robust global distribution business, and as you hinted at in the intro, making a brutally pragmatic decision to cut their clinical pipeline.
Right, but before we can really appreciate the financial mechanics of that transformation, we have to establish the physical reality of what they actually sell. The foundation of this whole story is their core business, which relies on proprietary specialty plasma therapies.
Exactly.
Their disclosures show they have 6 FDA-approved products, with names like Glacia, Kedrab, CYTOGAM, Vorizig, Winario, and Hepagam B. But merely holding FDA approvals doesn't guarantee a moat. It's the highly specific market position of these therapies that gives them leverage.
What's fascinating here is the monopoly-like status these therapies command in the market. To really understand the moat, you have to understand the stakes for the patients. Take CYTOGAM, for instance.
Okay, let's look at that one.
It is the sole FDA-approved immunoglobulin for preventing cytomegalovirus, or CMV, disease in organ transplants. Now, CMV is a common virus, but if you have just received a kidney or a heart transplant, your immune system is intentionally suppressed so your body doesn't reject the new organ.
Right, you have no defenses.
Exactly. In that vulnerable state, a CMV infection can be rapidly fatal. If you are a transplant patient in that situation, CYTOGAM is an absolutely critical, life-saving therapy, and Kamada is literally the only FDA-approved game in town for that specific indication.
The only one.
The only one. Then you have Vorizig, which is the sole FDA-approved option for chickenpox post-exposure prophylaxis in high-risk groups like, premature infants or pregnant women who lack immunity.
It's like being the only gas station on a 500-mile stretch of desolate desert highway. You aren't necessarily trying to sell the highest volume of gas in the entire world, but your customers absolutely have to come to you because you serve a rare, vital, and completely underserved need.
That's a great way to put it.
And nobody else can easily just set up shop next door.
Right. And the reason nobody can just set up shop next door is because the barriers to entry in specialty plasma manufacturing are astronomically high. We are not talking about mixing basic chemical compounds in a stainless steel vat to press a pill.
Yeah, it's not traditional pharma.
No, plasma manufacturing involves incredibly complex, fragile biological processes. Think of it less like a traditional pharmacy and more like a highly specialized crude oil refinery. In refinery, you take crude oil and use fractionating columns to separate it out into gasoline, diesel, and jet fuel.
Based on different boiling points, right?
Right. Plasma fractionation is basically a biological version of that. You start with human plasma, which requires intensive, highly regulated donor screening, and you use complex physical and chemical processes to separate out specific microscopic immune proteins.
Which sounds incredibly expensive.
Oh, it is. Add in the rigorous viral inactivation steps required by the FDA to ensure the final product is safe from bloodborne pathogens, and the regulatory hurdles alone take years and tens of millions of dollars to clear. That infrastructural complexity translates directly into intense pricing power and highly predictable, sticky demand.
But having a monopoly isn't enough if a larger competitor or a shifting supply chain can undercut you a few years down the line. So how does Kamada prevent that? They lock their partners into massive multi-year minimums. Let's do some partnership forensics here, because the corporate filings outline how Kamada has basically established a concrete revenue floor.
Yeah, the floor is key.
Let's look at Kejidrab, their anti-rabies product. They partner with a massive player called Kedrion to commercialize it in the U.S. In 2025, sales reached $54 million, which completely crushed the baseline expectations. But the real structural advantage is that Kamada has now locked in a firm commitment from Kedrion for $90 million in minimum orders spanning just 2026 and 2027.
And securing a firm $90 million minimum commitment on the books for a lead asset is a massive de-risking event. I mean, in corporate finance, predictability is incredibly valuable.
Oh, absolutely.
When management can look at their balance sheet and know with absolute certainty that $90 million in cash is contractually guaranteed to flow in over the next 24 months, it allows them to allocate capital with extreme precision. And that current agreement with Kedrion runs all the way through 2031.
That's a long runway.
It is. But you also have to weigh their partnership with pharmaceutical giant Takeda for Glassia, which is Kamada's therapy for alpha-1 antitrypsin deficiency. Takeda handles the commercialization in major markets like the US, Canada, Australia, and New Zealand.
Now, wait a second. I noticed a specific detail in the recent sources regarding that Takeda partnership, and I want to push back on this a bit. The documents clearly state that the Takeda royalty rate for Glassia stepped down to just 6% in August of 2025.
Yeah, that did happen.
So how is a major royalty cut a good thing for a growth story? That sounds like a structural headwind that would compress margins.
Well, on the surface, a royalty step down sounds negative, but analyzing the underlying structure of the agreement reveals a totally different reality. Yes, the percentage rate stepped down to 6%, but the trade-off is that Takeda guarantees Kamada a minimum of $5 million annually, all the way through the year 2040.
Wait, 2040, so a 15-year guarantee.
Exactly. In the biopharma world, having a guaranteed bond-like revenue stream stretched out over 15 years is practically unheard of. Furthermore, the actual expected royalties are projected to run much higher than the floor, usually between $10 million and $20 million annually.
Okay, that makes a lot more sense.
Yeah, so while the percentage is lower, the longevity and the guaranteed floor provide incredible stability. Plus, the filings point out that Kamada retains the direct sales rights in ex-US markets like Latin America and the CIS region. That provides them with an entirely separate, wholly owned growth vector for Glassia that sits outside the Takeda agreement.
Here's where it gets really interesting, though, because having a guaranteed revenue floor is fantastic, but it doesn't fully explain the massive margin inflection we mentioned at the start of the deep dive. How does a company rapidly expand its profit margins without just blindly selling more volume?
You cut the dead weight.
Exactly. You cut the dead weight. And in December 2025, Kamada made a ruthless but brilliant capital allocation decision. They abruptly halted their Phase 3 Innovate clinical trial. This is a massive, expensive trial for an inhaled version of an AT therapy. They stopped it due to a futility analysis.
Which means the early data showed it simply wasn't going to hit its efficacy endpoints.
Right.
To contextualize that, alpha-1 antitrypsin deficiency is a genetic condition where your liver doesn't produce enough of a specific protein that protects your lungs. Without it, patients essentially suffer from severe early-onset emphysema.
Terrible disease.
It is. And the inhaled therapy was an attempt to deliver that protein directly to the lungs. It is vital to emphasize that this trial was halted for lack of expected efficacy, not because of any safety or toxicity concerns.
Right, but the financial implications of walking away from this clinical failure are staggering. Running a global Phase 3 trial is a massive cash drain. By permanently discontinuing the Innovate trial, Kamada instantly eliminated between $5 million and $6 million in annual research and development costs.
Instantly. Just gone.
Yeah. Management confirmed in their forward guidance that outside of some minor wrap-up costs in early 2026, those savings are going to flow directly to their adjusted EBITDA. It is the ultimate EBITDA gift.
It really is an incredible gift.
It's the profound irony of the biotech sector that a failed phase 3 trial is exactly what this company needed to finalize its transition. By abandoning that trial, they essentially shed the last major piece of their risky biotech identity. They stopped throwing millions of dollars down the clinical hole and finalized their status as a pure-play commercial profit engine.
If we connect this to the bigger picture, it completely changes the lens through which we evaluate their forward guidance. Kamada is projecting double-digit organic growth for 2026. Their public guidance expects $200 million to $205 million in revenue and an impressive $50 million to $53 million in adjusted EBITDA.
And that's all organically.
All organic. Because they cut that phase 3 trial, those aggressive growth targets are absolutely not reliant on any risky pipeline assets succeeding. The business model is completely de-risked. They are generating that growth solely from products that are already approved, already partnered, and already selling in the real world.
Okay, so cutting R&D costs provides an immediate, massive boost to the margins today. The bleeding stops instantly, but you can only cut a cost once. How do you defend those expanding margins over the next decade?
That's where the physical infrastructure comes in.
Right. The corporate strategy points to a major move in vertical integration. Kamada isn't just content manufacturing the medicine anymore. They're moving to control the raw materials. They are expanding their proprietary plasma collection network via 3 centers in Texas, specifically Houston, Beaumont, and San Antonio. The San Antonio site is currently expecting FDA approval in the first half of 2026.
Yeah, and vertical integration in the plasma industry alters the fundamental economics of the business entirely. These 3 centers are expected to hit peak operational capacity by the end of 2027.
Okay, and what does that look like?
Well, when they do, Kamada will collect 2 distinct resources. First, they collect normal source plasma. This is standard plasma they don't necessarily need for their specialized niche products, so they can turn around and sell it directly to third-party manufacturers. Current estimates suggest this will add $8 million to $10 million in pure revenue per center.
Well, just from the excess.
Exactly. But the second, much more critical aspect is that they will harvest their own specialty plasma internally.
It's like a famous high-end restaurant buying its own organic farm. You can sell your extra everyday vegetables to other local restaurants for a quick cash injection, but more importantly, the rare bespoke ingredients you need for your own signature dishes just got significantly cheaper to acquire.
That's a perfect analogy.
And suddenly you are completely immune to global supply chain shocks or sudden price gouging from outside vendors. By producing their own specialty plasma, Kamada will drastically lower the manufacturing costs for their proprietary products starting in 2027. That is long-term structural margin defense.
You control the supply, you control the cost, and you isolate yourself from macroeconomic volatility. And while they are fortifying their U.S. supply chain, they are simultaneously expanding their distribution segment back in their home markets.
Oh, right, in Israel and the MENA region.
Yeah, in Israel and the broader MENA region, Kamada acts as an exclusive distributor for third-party medical products. A massive future growth driver here is their strategic partnership, heavily involving Alvotech, to launch a portfolio of biosimilars.
That's a growing market.
It's huge. Following recent successful launches, they have more biosimilars slated for regulatory approval and launched by mid-2026. This biosimilar portfolio alone is targeted to generate $15 million to $20 million annually within the next 4 to 5 years.
But building an economic moat also means defending the castle against new threats. Moats aren't static. CYTOGAM might be a monopoly for its specific indication right now, but there are always indirect threats in the medical field. I noted in the filings that they are actively launching a clinical defense strategy for CYTOGAM.
They are. CYTOGAM is facing emerging competition from newer antiviral drugs, specifically letermovir and maribavir, which are used to manage CMV infections.
So the antivirals are trying to eat their lunch.
Basically, yes. But instead of just letting those antivirals eat into their market share, Kamada is going on the offensive by launching the SHIELD study.
Okay, what does that do?
The goal of this study isn't to prove CYTOGAM is better than the antivirals, but to prove additive efficacy. They want to clinically demonstrate that using CYTOGAM alongside these antivirals produces a superior outcome for the transplant patient than using the antivirals alone. It is a highly strategic, relatively low-cost clinical study designed specifically to defend the commercial viability of their highest margin asset.
That is incredibly smart. Okay, let's translate this entire strategy, the moats, the cost-cutting, the supply chain integration into hard numbers. We need to look at the actual report card. Let's review the full year 2025 financials.
The numbers are incredibly strong.
Record revenue of $180.5 million, up 12% year over year. But net income hit $20.2 million, which is a 40% jump. That massive gap between top line and bottom line growth is the exact margin inflection happening in real time.
Yeah, that gap demonstrates textbook operating leverage. When your fixed R&D costs are eliminated, every new dollar of revenue you generate drops almost entirely to the bottom line as pure profit. That is exactly why they posted $25.5 million in pure operating cash flow.
Which is tangible.
Highly tangible. That specific metric is vital because it proves they aren't just generating accounting profits on a spreadsheet, they are converting that EBITDA into actual hard cash in the bank.
And that cash conversion resulted in a cash fortress of $75.5 million and negative net debt. But what management decided to do with that cash is perhaps the strongest signal of confidence a corporate board can possibly send. They instituted a formal dividend policy.
Which is so rare for a biotech.
In the biopharma world, where companies historically hoard every single penny to fund the next decade of clinical trials, a dividend is incredibly rare. Kamada declared a policy to distribute at least 50% of their annual net income back to shareholders.
50%.
50%. The inaugural dividend is 25 cents per share, totaling roughly $14.4 million, payable in April 2026.
Initiating a dividend policy that commits to paying out half of your net income fundamentally changes the investor base. You transition away from speculative retail traders looking for a clinical trial pop, and you start attracting institutional yield hunters and value investors.
It completely changes the profile of the stock.
It does. You do not make a recurring 50% net income commitment unless you have absolute bedrock certainty in the durability of your future cash flows.
It is a massive flex. But, as with any deep dive, we have to flip the coin. It all sounds bulletproof, but what are the blind spots? We must address the operational risks and the current market valuation to give you a complete, impartial picture. The first major risk highlighted in the corporate disclosures is geographical and geopolitical. Kamada's corporate headquarters and primary manufacturing base are located in Israel.
Right, and operating a global business out of Israel means that Kamada's physical supply chain, their local day-to-day operations, and their export logistics are inherently vulnerable to disruptions caused by regional conflict in the Middle East.
And we're reporting this impartially, just to be clear to you listening. We aren't taking any political sides here. We're looking strictly at the business realities as reported in the filings.
Absolutely. Regional instability is a stated, documented corporate risk factor that any analyst must weigh when looking at the reliability of their global distribution network.
Now, looking past the documented geopolitical risks, let's look at the market's perception of the stock. Despite this massive pivot to profitability, the double-digit organic growth guidance, and the new dividend policy, independent financial analysts currently have the stock broadly rated as a holdly.
A hold rating.
Yeah, old. Why? Because they argue that the 2026 execution is largely already baked into the current valuation. But when you actually look at the multiples, they seem absurdly low for the healthcare sector. The recent data shows an enterprise value to EBITDA ratio of just 8.79x and an enterprise value to revenue ratio of 2.09x.
This raises an important question. If a company is generating consistent double-digit growth, throwing off tens of millions in free cash flow, paying a robust dividend, and holds zero debt, why is it trading at a sub-9 EV to EBITDA multiple?
It doesn't really add up.
It doesn't. For a high-margin healthcare company growing at this rate, you'd historically expect a multiple in the mid to high teens. A sub-9 multiple means the broader market is essentially pricing this dynamic biopharma platform like a stagnant, low-growth utility company.
Right.
The market seems to be pricing Kamada purely on its current organic execution. And remember that highly bullish 2026 guidance, the $50 to $53 million in adjusted EBITDA, is strictly organic. It assumes zero external additions to the pipeline.
But they have that massive cash pile.
Exactly. Management has explicitly and repeatedly telegraphed to the market that they intend to use that $75.5 million cash pile for mergers and acquisitions.
So what does this all mean? It means the stock might be priced purely for the machinery they have running right now. The market is completely ignoring the $75.5 million sitting in their war chest. When a highly profitable company with zero debt goes hunting for commercial stage acquisitions to plug into an already optimized FDA-approved global distribution network, the upside can be explosive.
Oh, massively explosive.
The M&A potential is basically a massive unpriced call option sitting on top of an already undervalued cash generation engine.
It is a textbook value setup for a specialty pharma company. You are buying a highly defensive specialty plasma business surrounded by a massive economic moat. You are getting paid a tangible dividend yield while you wait, and you are essentially getting the management's aggressive M&A strategy for free.
Right.
By cutting the Innoviate trial, management proved to investors that they have the ruthless discipline required to protect capital. Now they have the war chest and the cash flow to deploy that capital aggressively into commercial stage assets.
It really forces you to reevaluate how you look at the entire sector. Think about that traditional biopharma model we discussed at the top of the deep dive, burning hundreds of millions of dollars on a prayer for a blockbuster drug, hoping the FDA smiles on you a decade from now while your equity is slowly diluted to zero.
It's an outdated model for a lot of mid-cap companies.
It is, and Kamada completely flipped the script. They looked objectively at a phase 3 pipeline drug, realized the data wasn't going to support the investment, and instead of throwing good money after bad to save face, they abandoned the dream. They chose to simply print cash today, reward their shareholders with a massive dividend, and buy their future growth through strategic M&A. Is this commercial first, R&D second approach the new blueprint for mid-cap biopharma survival in an era of high interest rates and cautious capital? It is definitely something to chew on. Risk defined, portfolio protected,